All right, welcome to this explainer. Today, we're doing a deep dive into the exact mechanics, the actual math, and the methods required to scale a crypto portfolio. We're putting a massive magnifying glass on Cardano, and we're going to look at the strategies, the historic timelines, and the sheer mathematical reality of trying to turn a $1,000 initial stack into $100,000. So let's tackle this completely provocative question right out of the gate. Hitting a 100x return in crypto? I mean, that's the ultimate hopium you hear about all the time, right? But to even entertain that idea requires an intense reality check on how markets actually operate. It's not magic. It's a really complex mix of timing, highly aggressive risk-taking, and compounding math.
Now, before we go any further, we absolutely have to hit this disclaimer. We are here strictly to educate. We're looking at source data, we're looking at models, but we are absolutely not giving you financial advice. Going after the kinds of massive gains we're modeling today carries incredibly high risk. And, what happened in past market cycles is absolutely no guarantee of what's going to happen tomorrow.
Okay, here's our blueprint for today. We'll start with the 100K Cardano goal, then move into staking and DCA strategies, touch on high-risk trading and DeFi, look at modeling realistic growth timelines, and finally, wrap up with risk management and security. Let's jump right into part one, the 100K Cardano goal, and the context of these massive gains. Let's just look at the sheer scale of the math we're dealing with here. To turn 1 grand into 100 grand, you need a staggering 100x multiplier. If you're starting with ADA, Cardano's native token, sitting around, say, 25 cents, hitting that 100x means the price literally has to surge to $25 a token. That is an enormous leap, and we really need to understand what actually triggers that kind of crazy momentum. Because historically, massive leaps in ADA's price don't just happen in a vacuum. They've always been directly tied to major technological catalysts. Look at 2017. The ICO hype drove a 3,000% run. Then in 2020, the Shelley upgrade brought us staking, which injected a massive amount of confidence into the network. 2021 brought Alonzo and smart contracts, and more recently, we've got Hydra and Voltaire tackling scaling and governance. The big takeaway here, price follows major development milestones. And just to put this into perspective for a second, ADA's all-time high was $3.09 back in September 2021. So thinking back to that math we just did, a push to $25, that would require entirely unprecedented market conditions. You'd have to smash through previous ceilings by an absolute mile.
Which brings us to part two, staking and DCA strategies. This is all about building a low-risk foundation.
Listen, staking is your absolute baseline. It's the most fundamental tool you have in the Cardano ecosystem. You set up an official wallet like Daedalus or Yoroi, delegate your ADA to a stake pool, and you're earning a compounding 4 to 5% annual yield. And here's the real kicker. The reason this is so crucial, unlike a lot of other networks out there, Cardano staking has 0 lockup periods, no slashing penalties, your funds stay entirely liquid, completely safe in your own wallet, all while generating passive growth. It's really a no-brainer. Now, when you take that staking yield and combine it with dollar cost averaging, or DCA, that is how you actually survive those wild historical price swings we were just looking at. Instead of stressing out, trying to time the market perfectly, which, let's face it, is almost impossible, you just invest a set amount on a regular schedule. It smooths out your entry price over time. Combine that with the constant compounding of your 5% staking rewards, and you've just built the safest, most reliable foundation possible for your portfolio. But hey, let's be real for a second. 5% a year is great, but it is not going to get you a 100x return in any reasonable time frame. And that brings us to part 3, high-risk trading and DeFi. We're talking about the accelerants. Look at this stark contrast here. On one hand, passive staking is safely anchoring your portfolio. On the other hand, you've got margin trading on exchanges. Using 2x to 10x leverage can heavily multiply your gains, sure. But, and this is a massive but, it comes with the terrifying risk of instant liquidation. Literally, if the price moves against your leverage position, your initial capital can be wiped out in seconds. Poof, gone. This is strictly a tool for highly experienced traders.
So, beyond margin trading, investors looking to hit the gas pedal often turn to DeFi, or decentralized finance. Providing liquidity on a DEX like MinSwap can get you those double-digit yields, but it introduces serious dangers like impermanent loss and smart contract bugs. Then you've got the highly speculative stuff, early token launches, flipping Cardano NFTs. Now, these can offer massive upside. We're talking 10x or more on a single play. But let's be clear, these markets are illiquid. They are wildly unpredictable, and honestly, most projects ultimately fail. If you're going to play in this sandbox, the source data strongly suggests limiting these highly speculative bets to just 1 to 5% of your total portfolio.
Okay, so if we put all of this together, how long does it actually take? Let's break down the data in part 4, modeling realistic growth timelines. This is the actual math behind the 100x.
All right, time for the ultimate reality check. Imagine a continuous raging bull market where your asset doubles every single year. So 100% growth per year plus your staking yield. In that perfect scenario, you could hit that 100K mark in about 7 to 8 years. But look at the moderate scenario. If the market only grows by a respectable 10% a year, you won't even come close, even over a whole decade. And if you're stuck in a bear market scenario, well, you're essentially just fighting off inflation at that point.
This table really spells it out. If you're relying solely on that safe 5% staking yield, it's going to take an almost infinite amount of time to reach a 100x return, unless the underlying price explodes. Just holding and doing DCA, that heavily depends on volatile market cycles, taking anywhere from 5 to 15 years. If you want to reach that 100K goal fast, you have to inject those high-risk strategies we talked about, spot trading, margin leverage. But remember, fast in this context also means a vastly accelerated risk of losing absolutely everything.
And because those aggressive strategies are so incredibly dangerous, our final section is dedicated entirely to protecting you. Part 5, Risk Management and Security. This is your shield. You really need to consider this your absolute survival checklist. Crypto markets are totally unforgiving, so protecting your capital is job number 1. That means strict position sizing, literally risking only 1 to 2% of your capital on any single active trade. It means using stop-loss orders, so you automatically cut your losses before things spiral out of control. And above all else, keep your long-term holdings offline. Put them in an industry-leading hardware wallet like a Ledger or a Trezor, and stick to fully compliant KYC exchanges when you do need to trade.
Oh, and one more absolutely crucial thing. Scaling your wealth responsibly means staying legally compliant, because guess what? The tax man loves crypto gains just as much as you do. In places like the US, ADA is legally treated as property. So every single time you sell or swap, boom, you trigger a taxable capital gains event. And those passive 5% staking rewards we all love, yeah, those are taxed as ordinary income at their fair market value the exact moment they hit your wallet. So keeping meticulous records of your transaction hashes and their USD values is not optional, it's mandatory.
As we wrap up this explainer, I want to leave you with this final question to chew on. We've looked at the safe baseline of staking, we've looked at the extreme, sometimes terrifying danger of margin and DeFi, and we ran the cold hard math of the timelines. Finding the balance between those high-risk accelerators and a low-risk foundation, it isn't some one-size-fits-all formula. It's a highly personal equation. So based on the data we unpacked today, which of these strategies actually aligns with what you are genuinely willing to risk? Dive into the research, run your own numbers, and I'll see you in the next explainer.